Warren Buffett keeps buying oil companies, especially Occidental Petroleum. But should you be following him into Oxy? I actually think that there's another opportunity here in the wake of Warren Buffett committing to this opportunity. And that's what I'm going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here's a Barron's article where Berkshire now owns approximately 17.4% of Occidental Petroleum, or OXY for short. And they lifted their stake in the energy company to almost $10 billion according to a filing on Friday. And we're in the long weekend right now. And so Warren Buffett now owns, or Berkshire Hathaway now owns, approximately 163.4 million shares. And their average price has been around $57 to $60 per share for their latest purchases. So effectively, they really like Oxy under $60 per share. And diving a little bit deeper into this article, you can see here that Buffett actually began buying Occidental earlier this year, and Barron's actually estimates that Berkshire's total cost basis for Oxy is around $53 per share, which means that because the share price has come up, as I believe that people are following Buffett into this name, and also he's taking the shares off the people who are less optimistic over the name, and so there's people who are more optimistic, so they'd be willing to sell it for a higher price. So the paper profit is approximately $1 billion, but I don't know if you could liquidate and generate that profit. But the real issue here, and this is sort of my thesis for the investment opportunity that I'm going to recommend in the later half of this video, is that the purchases have continued to fuel speculation that Berkshire will add further to its stake and reach approximately 20% or potentially bid for the entire company. And what this article is really getting at is that at 20%, Berkshire would get a different accounting treatment. And what I think that they're getting at there is the equity method of accounting for investments. So I'm not going to bore you with exactly what the equity method for treatment is, but in the accounting world, and this is my CPA hat coming on, there's three ways that you can account for investments. The first one is just a fair value method. That's how most investments are accounted for when you own less than 20%. There's the equity method when you own just a little bit more. And then there's the full consolidation method when you own controlling interest in the company. And so if you're interested, you can look those up. Now, here's the most interesting part of this play that I'm going to talk about at the back half of this video. If you go back to here, at the second last paragraph, Occidental said in its earnings conference call in May that it expected to begin a $3 billion share repurchase program in the second quarter. And so Occidental has not only been focusing on repaying its debt associated with its 2019 purchase of Anadarko Petroleum, but now they're going to be using some excess capital to buy up shares. So they're committing to a $3 billion share repurchase program at the same time where Berkshire Hathaway is also buying up shares. So there's a huge support for the shares, I would say at least at that $60 level. Well, what does that mean? Well, I personally think that you can sell cash secured puts at that $60 level and generate a pretty healthy yield if you weren't really interested in owning an oil. But Oxy is actually a very interesting oil company. So a lot of you guys may not know this, but my experience is predominantly in the oil and gas space. I worked in the Calgary team of an investment bank on the equity research side. And I actually spent a lot of time learning all sort of like the upstream, the midstream, and the downstream businesses for oil. And I'll explain a little bit of it for you guys. But what I really wanted to show you was Oxy's sort of business model. So you can see here that one of their priorities for delivering cash to their investors is by maintaining their current level of production. The second part is they're going to deleverage their balance sheet. So in the near term, they're going to pay down $5 billion of debt and reduce that net debt to $20 billion. And over the long term, they're going to continue to retire that debt as maturities come due. And then when it comes to returning capital, they expect to continue the dividend payments so long as the WTI, the West Texas Intermediate oil price is over $40 per share. And they've recently committed to a $3 billion share repurchase program. And so where exactly does Oxy fall? Like, are they more of an upstream company? Are they more of a midstream company? Are they more of a downstream company? Well, you can see here that Oxy is very much an upstream provider. So you can see that $13 billion of their 2020 revenues were from the oil and gas space. So that's the actual drilling. They do have some chemical products. Now, I don't know if that chemical products is a midstream business or if it's a downstream business. My guess would be that it's a midstream business, but they just separated for their own purposes. So that's around $4 billion of revenue. And then you can see that they have a small midstream business of approximately $2 billion or 1.76. But you can see the significant majority of their revenues do come from the upstream business. So they are very much an upstream producer. And so that leads to the question of where exactly are they producing? And the reason why you want to know where they're producing is you want to gauge the health of the basins where they're producing from. And so you can see here that their total fiscal year 2022 production is coming from just a few areas. So 60% of their exposure is in the Permian and Gulf of Mexico, i.e. that Texas area gold basins or deposits. A little bit more of their production is from the Rockies, and then of course they have some international exposure. But effectively what you're saying is that approximately 80% of the business overall is domestic in North America, and 60% is from that Texas and Gulf of Mexico regions. And so I want to dive a little bit deeper into that. So when we think about the Permian Basin, what we do have to get an idea is this is a basin that's been used for a long time. And so what does this basin still have left to drill? And so scientists say that this is a giant play, which of course straddles the border of Texas and New Mexico. And I'll show you it on a map after, but it's produced for about 100 years and it likely has decades of life left, both economically and geologically. But a lot of the drilling, because it's a shale play, shale's a little bit more expensive. And so practically speaking, it all depends on the oil prices in order to unlock the oil that's locked in that sort of shale rock there. And you can see here, this is sort of a map. You guys who are new to the oil space may not necessarily be aware of all the oil basins that exist in just the lower 48 states as it stands. Obviously, you can see at the very top there's the Bakken. So that's like that North Dakota play. That's where a lot of the oil drilling was happening when the oil price sort of declined in 2015. Just above that, that's sort of like the Calgary, Edmonton area. So that's the area that I was focusing on. Huge infrastructure built there. A lot of those oil sands do come down using the Keystone pipeline and other lines, and they go down into the Gulf. So that does happen. Notice on the bottom left, that's your Permian Basin. So you see how Texas straddles New Mexico. So that's kind of that whole Permian Basin. And then in the dark colors, that's the current plays that are currently happening, but the basin is obviously larger. And then a little bit further south, you can see that that's the Gulf of Mexico. So it straddles Mexico, Louisiana, Florida. And so that's where 20% of OXY's drilling is. And then I just wanted to point out on the top right, OXY does not have exposure to the Utica and Marcellus, but this is another big drilling area. And so if you're looking to invest in the oil space, you can see that the Marcellus and Utica is another place where a lot of drilling is happening. So drilling is happening all throughout. And then of course you can see in California in the far left, you can see that there is also drilling in the Monterey. And so there's a lot of drilling happening, but just sort of wanted to show you exactly what their plays are. Their plays are the Permian, which is the bottom left there, and the very bottom, the Gulf of Mexico. And so what I was trying to get at is if Berkshire is buying up as many shares as they can, $60 per share or lower, and if they're going to be putting more pressure on the shares as a company overall by buying up more shares with their $3 billion repurchase, which reflects approximately 6% of the overall market cap for the company. So you have Berkshire vying for a significant amount. You also have 6% of the company being purchased just by the company alone. You have a lot of support at that maybe $60 per share level. And it's not like oil prices are going down anytime soon. So you're going to have more support for that $60 per share level as the company continues to buy up even more shares as time goes on. And so what I wanted to do is I wanted to look at sort of those cash secured put opportunities. And you can see here, I speculate that Berkshire's aggressive purchases at under $60 per share and OXY's share repurchases commitments have put a bit of a floor on the share price, which I estimate to be around $60 per share. So at that $60 per share area, the January 19, 2024 cash secured puts are at the money right now because the share price is around $60 per share. And so that at the money amount yields 16% with a net purchase price under what Warren Buffett's Berkshire has been buying it at $45 per share. So if you want to own this company for under what Berkshire has been buying it at, because you're a smaller investor, you get access to tools that Berkshire doesn't have access to. So you can actually do this. So best case scenario, you buy the shares for $45 a share. Worst case scenario, you get a 16% yield. So no matter what, you win. Now, if you don't necessarily want to get exercised on the shares, you can purchase the out of the money, or you can sell the out of the money cash secured puts. That'll generate a 13% yield on the $50 exercise price and give you a net share purchase price of $40 per share. Or if you really believe that there's significant upward pressure on these shares, you can sell this at approximately a 21.5% yield. So that's in the money with a net purchase price of approximately $50 per share. Now, when it comes to in the money, you could also just buy the shares and sell covered calls. So you can do the same thing. It effectively works out to the same. So up to you how you want to play it. But the point that I wanted to make is there's some interesting opportunities. I'm really liking the at the money play of $60 and you get that 16% yield. It really complements my portfolio and it's something that I look to deploy. Now look, I'm looking to deploy six figures before the end of the year. And so this is an interesting opportunity that complements my portfolio that doesn't really have much energy exposure right now. Back when the market declined in March of 2020, one of the bigger positions that I did take was midstreamers and oil drillers. So Exxon, Chevron, Pembina in Canada, a few US pipeline companies that were yielding around 20%. I was buying into all those names because I just felt like oil was a huge opportunity back then. And then subsequent to that, I largely sort of like turned away from oil and I was looking at other types of opportunities. But now I'm starting to sort of come back into it and at least complement the portfolio as a whole with some energy exposure. And the reason why I was looking to diversify away from the oil business is because I do believe that there's a lot more exciting opportunities in the market right now. You can see here that there are 10 names trading under the 50% of their intrinsic value, and I've sort of unlocked a few of them so you can see. There's Alibaba and Best Buy. There's 20 names trading between 50 and 75% of their intrinsic value. You can see I've unlocked a few of those. So you got Zillow, Alphabet, HP, Inc., Meta, Dave & Buster's, and Canada Goose. And every single name on this tracker has a full detailed model supporting the valuation, which you can get to at the lower tier of the Patreons, where you can get access to all of the models. And the other thing I don't really talk a lot about, but I'm talking more about it recently, is that every month at the higher tier of the Patreons, there's a live presentation with all of the Patreons at that higher tier. And my very best research is reserved for that call. And there's always some exciting opportunities. And we also live value companies if people decide that that's something that they want to have happen on the call. And like I always say, there's never any risk to you, because if you decide to try it out and you decide that it's not for you, no problem. Message me in the app before you cancel and let me know that it's not for you, and I'll completely refund the full first month subscription, because that's how much I believe in the product, that's how much I believe in the research, and that's how much value I do believe that you will get, that I'm pretty much making a bet that you're not going to want to unsubscribe. Now, with that said, one of the names on the list was Abercrombie. And I truly believe that that's a name that's really been one of those babies thrown out with the bathwater. And I made a full video analyzing that opportunity, and you can get to that video right here.